Hello and welcome back to our channel The Running Bulls. Let's talk about from basic to advanced option trading in stock market NSE India. So in this topic we are going to discuss about what is CE call option, what is PE put option, what is strike price and how to choose the strike price, relevant strike price that can help us make some profit. What is risk reward ratio and how to calculate it, why it is importance and not importance, that we'll see in the advantage and disadvantage section. How to trade in options, that is this means that how you're gonna make profit from option trading, and advantage and disadvantage of the option buying and selling, that is both types. So in advanced section, we're gonna see what is option selling, that is also known as the option writing. How do we do the option writing? Capital required for the index option writing, advantage and disadvantage. So without further ado, let's move forward. C is known as the call option and P is known as the put option. CE or call option is a contract in which buyer has the view of the market going upwards. So whenever we have a view that the market or the price will go up, it will move up. So we'll buy a CE. The price will move upward from the current level. So there always be a price that like for example it is trading at 100 rupees. So what we'll do, we have a view that it will go to 110. We'll buy a CE. It is also known as bullish view, and let's see one example for it. In this chart, 15-minute chart, the market is about to make a bottom. So what we'll do, we'll buy a call option, and after that we'll we'll set our target and we'll keep our stop loss. In this way, we'll be not going out of our capital. Second thing is we'll buy the nearest strike price, that is around the 16,000. So let's see. So we have buy a call option, and let's see. So see, it is moving up. So in this market we'll buy a call option and we'll take our target. Our target is this, that is achieved, and then we'll exit. What is the put option? Put option is the contract in which the buyer has the view of market going downwards. The price of the price will move downwards from the current level from a particular point. It is also known as the bearish view. Let's see with an example. So my for let's see an example for the put option. So my view is bearish. So I'll buy a put option of the nearest strike price, that is 15,700 PE, and since my view is bearish, so the market will go downwards, will move downwards. So this will be our entry point. So when the market will come below this line, we'll make an entry, and this will be our target. So let's see what happens next. So market is falling, market is continuing, it breaks this line, we buy the PE and we'll wait for the target. Now our target on this candle has been achieved, so we'll exit from the PE. Friends, let's now talk about the option chain. So friends, this is the option chain. Option chain is also known as the option matrix. It is the listing of all the options contracts for a given securities. Securities can be stock, index, or it can be in commodities also. So it shows the all the listed puts, calls, CE, that is CE and PE, their expiration date, their strike price, volume, and price information. So let's check. So this is the example for the option chain. You can check on the nseindia.com option chain. So from there I have taken. So in this you can see the volume, last trade price, change percentage, and the strike price. All the strike price available for the index, that is Bank Nifty. So here you can check the strike price. Also you can check further many more details I want to tell you. The first thing is that 34,500 is called the out of the money because it is far from the current trading value of the Bank Nifty. Currently Bank Nifty is trading around like 34,300, so that is called the in the money. and 34,500, 600, 700, 800, 900, they all are the out of the money call options. So this is just a term, so don't get confused. Similarly, in put option, going downwards, like 34,100, 34,000, 33,900, 33,800, these all will be the out of the money put options. In the money, all the gray part that you are observing, that will be the in the money call options or put options. So like 34,200, 100, 34,000, 34,900, these will be the in the money call options, and 34,500, 600, 700, 800, this will be the in the money put options. So it is reverse for the put, and like you have to like just observe it for some of the days, and you'll understand that thing. So friends, risk reward ratio. So risk reward is the amount of risk that you are taking. Like for example, if I'll take a position from this side, and my view will be of downwards, like bearish view, and this will be our target, and this will be this level will be of stop loss. Like from here, if the price start moving upwards, opposite from our view, so we'll cut the position, so that will be a stop loss. So that is like in this case it is 1:4. So 1 ratio is our loss chances of taking risk, and 4 is the reward. So let's start. So we'll take the position once it will hit this first bar. From here we'll make a PE position, that is the put bearish position. So this has hit that part. It moves very fast, very swiftly towards the downside, and this will be our target. So once our target will achieve, we'll cut the position or square of the position. So let's see it's moving downwards and it hit our target. So we'll square up our position and we'll exit from the trade. The advantage and disadvantage of the option buying. Option buying has a higher return potential. For example, if you purchase an option at rupees 5, and it has the potential to reach anywhere, like even it can go to 100, 200, 500 or anything like that. So options always have a high return potential even by investing a small amount. Second thing is the lower risk. Always like option has a lower risk, as you are buying the option, you are only investing a part of the money and taking a calculated risk. So for example, if you are buying a call option at 5 rupees into the lot size that is 25, so your total purchased will be of 125 rupees. So amount at the risk will be of only 125 rupees, whereas it has the potential to go to 100, 25, 30, 50, 200, anything like that. So with the investment of a small amount, you are taking with a small risk, you are trying to capture high potential or high rewards. Time decay. Main disadvantage is the time decay. The option has an expiry date, due to which out of the call option or even the in the money call option tends to lose its value. Like for example, if you have purchased it at 5 rupees, so even if you have a bullish view and you have purchased out of the money call option or put option, and your view is correct, but it will not give you a good return because of the time decay. Tip: start trading in index option in the beginning, as it requires less capital and easy to understand. So index like Bank Nifty and Nifty, these are the best index to trade.